Okay, for those of you who aren't familiar with me or my work, my name is Shiraz Ahmed. I am a professional financial advisor and associate portfolio manager with Sartorial Wealth of Raymond James, located in Toronto, Canada. I work with hundreds of families across both Canada and the United States, and in today's video, I wanted to go over fundamental analysis, also known as fundamentals for evaluating stocks. I'm also uploading new content every week, so please do consider hitting that bell icon so you're notified the next time I upload. Fundamental analysis is a method of measuring a stock's intrinsic value by ultimately examining related economic and financial factors. As pretty much anything can affect the price of a stock, fundamental analysts will have to account for a variety of factors like the state of an economy, industry conditions, or even microeconomic variables like the quality of a company's management team. The goal is really to arrive at a number that any investor can compare with the security's current price to see whether or not it's undervalued or overvalued. Basically, you're trying to see, is this a good deal or not, really in plain English. And that's really the crux of what a fundamental analyst is trying to do, is see what is this company's worth, and am I buying this at a good price or not a good price? Or should I maybe just avoid it for now? So 3 key points you want to keep in mind when thinking about fundamental analysis are: number one, fundamental analysis is a method of determining a stock's real, or what we call fair market value. Fundamental analysts are searching for stocks that are basically mispriced, or looking for an opportunity really, that are trading at either higher or lower prices than what the real value are. If the fair market value is higher than the current price, then the stock is considered to be undervalued, also known as being on sale, and maybe is a good deal and you should maybe consider picking that one up. And that's really what they're trying to do. So one of the main challenges that fundamental analysis has is that because it's so broad and almost anything can affect the price of a stock, so we want to look at some of the more obvious points, and I think that's where your time is typically best spent. And there are obvious points that would include, numerical items like revenues and profits and other ratios that I'll get into later. These are known as quantitative factors, but they can also look at other non-numerical variables, like I mentioned earlier, the quality of a company's management team. And these are known as qualitative factors that are non-financial in nature, but are important to be mindful of. So some of these qualitative items that people really often look at are not only the company's management team, but the business model. Is this something that you think they have a competitive advantage with or not? These are important things that you want to look at when assessing the viability, at least from a qualitative standpoint, about any investment. Okay, so that being said, and that's kind of a little bit about quantitative and qualitative, and that's a loaded subject, so I'm going to get into that in another video in the future, but let's get into kind of 2 main approaches that anybody using fundamental analysis to try to find the value of a security needs to be aware of. And these are what we call top-down or bottom-up analysis. So top-down is pretty much exactly as it sounds. It starts at the top, or the big picture, and considers things like the health of the overall economy. There are key macroeconomic factors that top-down approach will be paying attention to, like movements in interest rates, inflation rates, and gross domestic product, etc. The main goal is that you're trying to determine what the overall direction that the wind is blowing is for the economy, and ideally this will lead you to help identify industries or sectors within the economy that are poised to do well given the circumstances. An example of how this really kind of played out, at least for me specifically, was in March of last year in 2020. It was kind of the depth of the COVID crisis, and in my practice, we did a real deep dive into the stocks that we were owning for our clients. And we really tried to take that top-down approach about seeing what effects COVID could have on the broader economy. And this really helped us eliminate many COVID-sensitive sectors, like the travel and entertainment industry, and led us to substitute them for emerging themes that did really well in hindsight, like telehealth or even virtual conferencing. So the key takeaway from top-down is it looks at big picture factors and tries to narrow it down to help identify what you think are the best solutions for that problem. Now, on the flip side, there's also bottom-up approach. And instead of taking that big picture into account, bottom-up actually literally dives into the analysis of an individual stocks and almost ignores the big picture altogether. And the theory of bottom-up is that this approach, that there are some individual stocks that may perform better than the overall industry, and therefore they can concentrate their efforts on these microeconomic factors, such as a company's earnings or financial metrics, that will really lead your analysis. And there isn't a right or wrong, and there are very valuable items that you can get from both top-down and bottom-up. And so really neither approach is better, but it's just really kind of the lens that you want to go towards. And what we find is that bottom-up stock pickers are really exactly that. They're trying to find and dig in deep with individual companies and get to know them really well, down to meeting with their management teams and or really getting into the nitty-gritty of their financial statements to really understand what is it that this company is all about and how are they going to be, frankly, a better solution than perhaps some of their competitors. So they don't really care so much about what's going on in the big picture. They're looking to say that, you know what, the wind may be blowing, but I want that cement pole that's in the ground that's going to do well no matter what. And that's really what bottom-up approach is all about. Okay, so this is kind of just skimming the surface on fundamental analysis as a whole. And like I said earlier, I think I'm going to take a separate video to go into some of the more specifics on fundamental analysis and some of the quantitative metrics that people do look at. And I'll do that in another video, and it'll be a bit more in depth. So in the meantime, I'd love to know if you're more of a top-down or bottom-up investor. Do you focus more on quantitative metrics, or are you more of a qualitative type person? Really, there isn't a right or wrong, like I said earlier, but it's really interesting is that people tend to develop a style based off of kind of how you think. So I'll put my contact details at the end of this video. Please drop me a line. I'd love to hear more from you guys on that. And if you found this video of value, please consider hitting that like and subscribe button, as it really does help the algorithm pick up creators like me. I'm going to try to come up with interesting topics for you guys, and really the idea is, as a professional, these are some of the things that I talk about with my clients all the time, and we really want to just give you the straight goods. So I really appreciate you guys taking the time to watch this video. Thank you for the support, and stay safe out there. Bye for now.